Did you know that nearly 90% of millionaires either made their fortune in real estate or used it to grow their wealth? That's no accident. Real estate has long been called the king of investments, and for good reason. Unlike many assets, it not only grows in value over time, but can also provide steady streams of income along the way. Real estate isn't just about owning a house or a piece of land. It's about learning how to use property as a tool to create lasting wealth. From passive rental income to flipping undervalued homes, from commercial properties to modern platforms like Airbnb, real estate offers countless opportunities to build financial freedom. In this video, we'll explore 7 powerful ways you can build wealth through real estate. Whether you're just getting started or already on your wealth-building journey, these strategies will show you how the world's wealthiest people leverage real estate to multiply their fortunes. So if you've ever wondered how ordinary people become millionaires through property, stick around, because you're about to discover the very same strategies they use. Number 1, rental properties. Rental properties are one of the most reliable and proven ways to build wealth. And it's no surprise that millionaires around the world swear by them. When you buy a residential home, an apartment building, or even commercial real estate like office space or retail shops, you're essentially creating a money machine. Every month, tenants pay rent, and that money flows directly into your pocket as steady cash flow. This is powerful because it provides consistent, predictable income, unlike businesses or investments that may fluctuate wildly. But the magic of rental properties doesn't stop there. While you're enjoying monthly income, your property itself is quietly appreciating in value over time. Real estate historically rises in value due to inflation, demand, and limited supply. That means 10 years from now, the building you bought today for $200,000 could be worth $350,000 or more, giving you not just the rent profits, but also a capital gain when you decide to sell. Millionaires especially love rental properties because they provide a double advantage. 1, short-term income, the rent that comes in every month. 2, long-term wealth growth, the increasing property value over the years. On top of that, rental properties come with tax benefits. Many expenses, like repairs, maintenance, insurance, and even mortgage interest, can be deducted. This lowers taxable income and helps investors keep more money in their pockets. Another key advantage? Leverage. Unlike most investments, you don't need to pay the full price of a property up front. You can use a mortgage to buy the property, meaning you're using the bank's money to build wealth. Over time, your tenant's rent helps pay off the loan, while the property keeps appreciating. Essentially, you're building equity with other people's money. This combination of steady cash flow, property appreciation, tax advantages, and leverage makes rental properties a cornerstone of wealth-building strategies. That's why you'll find rental income as one of the common denominators among millionaires. It creates both financial security today and long-lasting wealth for the future. 2, house flipping. At its core, house flipping is about buying properties at a low price, improve their value, and sell at higher price. The strategy sounds simple, but the real magic lies in timing, research, and execution. Millionaires who excel at flipping homes don't just buy any cheap property, they look for undervalued homes. These could be houses in good neighborhoods that need cosmetic upgrades, properties in areas where demand is rising, or distressed homes that can be purchased below market value. After purchasing the property, they renovate with purpose. Successful flippers don't pour money into unnecessary luxury upgrades. Instead, they focus on changes that add the most value for the lowest cost. For example, updating kitchens and bathrooms, high return on investment, improving curb appeal with landscaping and fresh paint, fixing structural or safety issues that might scare off buyers, adding modern touches like energy-efficient windows or smart home features. But flipping isn't just about swinging a hammer. It's about smart project management. Every day a property sits unsold, costs like taxes, insurance, utilities, and loan interest eat into profits. That's why flippers carefully manage contractors, timelines, and budgets to make sure renovations are completed quickly and efficiently. The real challenge and opportunity lies in market knowledge. A skilled flipper knows how to analyze local housing markets, spot neighborhoods that are trending upward, and predict what buyers want. They buy when others are overlooking an area, renovate with the buyer in mind, and sell just as demand peaks. When done right, flipping can yield large lump sum profits in a short time, sometimes tens of thousands, even hundreds of thousands, from a single property. But when done wrong, overpaying, overspending on renovations, or misjudging the market, it can quickly turn into a loss. That's why millionaires who flip houses treat it like a business, not a gamble. They research deeply, run the numbers, plan renovations strategically, and move fast to minimize costs. The reward? Big profits in months instead of years, making house flipping one of the fastest wealth-building strategies in real estate. To successfully flip a house, you need to observe these 5 stages. 1. The hunt, finding the right property. The journey starts with spotting a property that's undervalued but has hidden potential. Don't just buy any cheap house. Study local markets, look for areas with rising demand, and target homes that can be bought below market value. Common sources include foreclosures, auctions, estate sales, or motivated sellers. The goal is simple: buy low in a good location. 2. The math test, running the numbers. Before buying, successful flippers crunch the numbers carefully. Calculate purchase price, how much is it worth today? Renovation costs, what will it take to fix it? Carrying costs, taxes, insurance, utilities, loan interest while you hold it. After repair value, ARV, what it will sell for after renovations. Doing this will help you know when to walk away, especially if the potential profit margin isn't big enough. Millionaires know that making money in real estate happens at the buying stage, not just the selling stage. 3. Adding value, not luxury. Renovating with purpose. This is where many beginners mess up. Millionaires renovate strategically, not emotionally. They invest in upgrades that give the highest return. If you want to successfully flip a house, important upgrade like transforming the kitchens and bathrooms to modern equipment. Change the paint, flooring, and lighting. Create strong curb appeal because first impressions matter, and fix safety and structural issues. The focus is always on what the future buyer values most, not on making the house overly fancy. 4. Managing the project. Every extra day the property sits unsold costs money. That's why millionaires are master project managers. They hire reliable contractors, set clear timelines and budgets, monitor progress closely, avoid delays and cost overruns. The faster and more efficiently the flip is completed, the higher the profit. In flipping, speed equals success. And lastly, selling at the right price, the exit strategy. Once renovations are done, it's time to sell. You need to work with competent real estate agents, stage the home attractively, and market it aggressively to sell quickly. When done right, this final stage turns all the hard work into a big lump sum profit, often in just a few months. 3. Real estate investment trusts, REITs. Not everyone wants the stress of being a landlord, fixing broken pipes, chasing tenants for rent, or worrying about property taxes. That's where REITs, or real estate investment trusts, come in. A REIT is essentially a company that owns, operates, or finances income-producing real estate. Think of shopping malls, office buildings, apartment complexes, hotels, hospitals, or even data centers. Instead of buying one apartment building yourself, you can buy shares of a REIT and instantly own a fraction of hundreds or even thousands of properties managed by professionals. Here's why REITs is important. 1. Passive income, without landlord duties. REITs are legally required to pay out at least 90% of their taxable income as dividends to shareholders. That means steady cash flow for investors, often much higher than what you'd earn from a savings account or bonds. And unlike rental properties, you don't need to worry about maintenance or tenant problems. 2. Accessibility and liquidity. Buying a physical property might require tens or hundreds of thousands of dollars, but REITs are different. You can start investing with just a few $100s by purchasing shares through the stock market. On top of that, REITs are liquid investments, meaning you can sell your shares quickly, unlike a property, which could take months to sell. 3. Diversification made easy. A single property investment ties you to one location and market risk. But with REITs, your money is spread across dozens or hundreds of properties in different cities and sectors. For example, residential REITs, apartments and housing communities. Commercial REITs, offices and shopping centers. Healthcare REITs, hospitals and senior housing. Industrial REITs, warehouses and logistics facilities. Specialty REITs, data centers, cell towers, storage units. This diversification shields investors from downturns in one sector while still allowing them to benefit from overall real estate growth. 4. Growth potential and inflation. Hedge real estate generally appreciates over time, and rents tend to rise with inflation. That makes REITs an excellent hedge against inflation. Millionaires love them because they provide both dividend income today and long-term growth tomorrow. 5. Professional management. When you buy into a REIT, you're not just buying property. You're buying into a team of professional real estate managers who know how to acquire, lease, and develop properties profitably. It's like outsourcing all the headaches of property management while keeping the rewards. REITs are a gateway into real estate wealth without the barriers of huge capital, tenant issues, or property maintenance. They allow everyday investors to earn passive income, build long-term wealth, and diversify their portfolio, all while enjoying the benefits of real estate ownership. 4. Short-term rentals, Airbnb, Vrbo. Turning a property into a short-term rental has completely changed the game for real estate investors. Unlike traditional long-term leasing, where tenants pay fixed rent every month, short-term rentals through platforms like Airbnb, Vrbo, or Booking.com allow you to rent your property on a nightly or weekly basis, often at much higher rates. Here's why you should jumping on this strategy. 1. Higher earning potential. One of the biggest attractions of short-term rentals is their ability to generate significantly more income than traditional leases. For instance, a typical long-term tenant might pay $1,000 per month in rent. However, if you rent the same property on a platform like Airbnb at $100 per night and manage to book just 20 nights in a month, you're already earning $2,000, double the income of a traditional rental. In high-demand tourist areas, this number can skyrocket even further, with many properties bringing in 2 to 3 times more revenue compared to long-term leases. This extra income gives millionaires the leverage to reinvest, scale faster, and build wealth at a much quicker pace. 2. Flexibility and control. Unlike traditional rentals where a tenant might lock your property for a year or more, short-term rentals offer unmatched flexibility. As the property owner, you get to decide when your property is available and when it's not. Want to use the property for a family vacation? Simply block off the dates. Need to maximize profits? Adjust pricing dynamically to charge higher rates during peak demand seasons, such as holidays, festivals, or local events. And if market conditions shift, you can always switch back to long-term renting. This level of adaptability is why millionaires are drawn to short-term rentals. It gives them full control to maximize returns while minimizing risks. 3. Growing global demand. Tourism is booming worldwide, and with it, the demand for unique, affordable, and comfortable short-term rental options. Travelers are increasingly favoring Airbnb stays over hotels because they want more space, privacy, convenience, and the authentic, home-like experience of living in a neighborhood rather than a resort. Platforms like Airbnb, Vrbo, and Booking.com have made it incredibly easy for property owners to reach millions of travelers globally without needing expensive advertising campaigns or real estate agents. For investors, this growing global demand means a steady flow of customers and strong occupancy rates year-round. Property appreciation bonus. What makes short-term rentals even more powerful is the dual wealth-building advantage they offer. While the property is generating strong cash flow from frequent guests, it's also appreciating in value over time. This means investors get to enjoy two layers of profit: consistent, reliable rental income in the short term and long-term equity growth as the property increases in value. For millionaires, this is the perfect combination: immediate cash flow to reinvest and long-term wealth accumulation that strengthens their financial foundation. 5. Challenges millionaires plan for. Of course, the short-term rental business is not without its challenges. Managing an Airbnb or vacation property requires constant cleaning and maintenance after guests leave, regular communication for check-ins, answering questions, and handling reviews. On top of that, property owners must ensure compliance with local regulations, as many cities are tightening rules on short-term rentals. But here's the millionaire mindset: they don't let these challenges stop them. Instead, they hire property managers or co-hosts to handle operations in exchange for a small percentage of the revenue. This allows them to keep the business running smoothly, earn passive income, and scale by owning multiple properties without being tied down by day-to-day management. At the core, short-term rentals aren't just about letting out a spare room. They're about building an experience-driven business. Millionaires think bigger and more creatively. Some design themed vacation rentals, others focus on luxury Airbnb listings with premium pricing, and many diversify across multiple properties in top tourist destinations. For them, Airbnb and other platforms are not just side hustles, but full-scale business models that can generate consistent, scalable wealth. By approaching short-term rentals strategically, they transform ordinary properties into powerful wealth-building assets. 5. Commercial real estate. When most people think of real estate, they picture buying a house or apartment and renting it out. But millionaires often go further by investing in commercial properties like offices, retail spaces, warehouses, and industrial facilities. These properties typically bring in much higher rental income compared to residential units because businesses are willing to pay premium rents for the right space, whether it's a downtown office, a store in a busy shopping district, or a warehouse in a logistics hub. On top of that, commercial tenants usually sign long-term leases, often between 5 to 20 years, which gives investors predictable and stable income without the hassle of constantly looking for new renters. Another big advantage is diversity. Commercial real estate offers different opportunities, such as office buildings, retail stores, warehouses, and factories, allowing investors to spread their risk and tap into multiple industries. Unlike residential real estate, the value of commercial property is directly tied to the income it generates, meaning that if you improve the property and increase rental income, the overall value of the property can rise significantly. Millionaires also love the fact that in many commercial leases, tenants cover expenses like maintenance, insurance, and property taxes, leaving the owner with lower costs and higher profit margins. Of course, commercial investing requires larger upfront capital, careful market research, and sometimes professional management, but the payoff is huge. For millionaires, it isn't just about owning a property. It's about owning reliable, long-term income streams that keep growing in value over time. That's why commercial real estate remains a cornerstone in many wealthy portfolios, combining steady cash flow with wealth-building appreciation. 6. Land development and appreciation. One of the most powerful but often overlooked strategies wealthy investors use is buying land in developing areas. Unlike stocks or houses, land is a finite resource. No one is making more of it. This scarcity alone makes it a valuable asset, especially in regions where cities are expanding and populations are rising. Smart investors look for land in the path of progress, areas where infrastructure projects, highways, schools, or new businesses are being planned. By purchasing land early, when demand is still low and prices are cheap, they position themselves to benefit massively once the area begins to grow. As cities expand outward, the once inexpensive land suddenly becomes highly desirable for residential housing, commercial spaces, or industrial projects. This creates two main opportunities. Investors can sell the land at a premium for a large lump sum profit, Or they can develop it into income-generating properties, such as apartment complexes, shopping centers, or office spaces. In either case, the value of the land multiplies far beyond its original purchase price. Wealthy investors also like land because it has low holding costs compared to developed properties. In many cases, you don't have to deal with tenants, maintenance, or repairs. This makes it a quiet investment that can sit and appreciate while you wait for the right timing. Of course, it requires patience and vision because the returns may take years to materialize, and not all land is equally valuable. Factors such as zoning laws, access to utilities, and future city planning play a big role in determining whether land will skyrocket in value or sit idle. Millionaires succeed at this strategy because they do their homework. They study population trends, follow government development plans, and anticipate where the next wave of demand will hit. By spotting opportunities before everyone else, they turn empty plots of dirt into multi-million-dollar assets. For them, buying land isn't just speculation, it's foresight in action, a long-term play that has built fortunes for centuries. Number 7. Real estate syndications and partnerships. Estate syndications and partnerships are powerful wealth-building strategies that allow investors to participate in large-scale real estate deals without needing to front millions of dollars individually. Instead of shouldering the entire financial burden of purchasing massive properties, such as apartment complexes, shopping malls, office buildings, or hotels, investors pool their resources together. This collective approach makes it possible to access opportunities that would normally be out of reach for most individuals. Here's how it works. A syndicator or sponsor identifies a lucrative property, organizes the deal, and manages the investment. They bring together a group of investors, each contributing a portion of the total required capital. In return, every investor owns a proportional share of the property and is entitled to a portion of the income and profits it generates. For example, while a luxury apartment building might cost $20 million, a syndication structure could allow dozens or even hundreds of investors to own a piece of it, each reaping the benefits of rental income and long-term appreciation. The biggest advantage is leverage. By pooling funds, investors gain exposure to high-value, cash-flowing properties that are generally more stable and profitable than smaller single-family homes. These larger properties often come with long-term tenants, higher rental yields, and professional property management, which means fewer headaches for the investors themselves. Instead of worrying about fixing broken toilets or chasing late rents, investors enjoy passive income as the syndicator handles day-to-day operations. Another benefit is diversification. For many investors, putting all their money into one property carries significant risk. With syndications and partnerships, they can spread their investment across multiple projects and asset types. For instance, an office complex in one city, a hotel in another, and a shopping mall elsewhere. This reduces risk while still capturing strong returns. Of course, estate syndications also require trust and due diligence. Since investors rely on the syndicator's expertise, reputation, and management skills, choosing the right sponsor is crucial. A skilled sponsor with a proven track record can make the difference between steady, compounding wealth and a disappointing return. For millionaires and savvy investors, syndications are a scalable path to wealth. They allow participation in projects that produce significant cash flow, offer appreciation potential, and build equity, all without the investor needing to manage properties personally or come up with millions up front. In short, estate syndications transform the power of community investing into an engine for financial growth, making it possible for individuals to own a slice of massive, wealth-generating real estate empires. Lesson: real estate creates wealth not just by owning property, but by leveraging appreciation, rental income, tax advantages, and partnerships. That's why so many millionaires have real estate in their portfolio.